Jonathan's not going to be here today. Jonathan and I traded because I'm going to be gone next week. So I'm taking the valuation stuff, which is actually listed after the midterm on your syllabus. Although it's on the midterm, so you definitely want to cover it beforehand. We're going to do that today. We're going to do valuation stuff. We're going to do comparable stuff. We're going to do a quick recap of the material that I've covered before. And we're going to take a sample of the midterm problems. Probably towards the end of class today. But I talk quickly, so we'll try to get out of here still well before 10. I was mentioning before, our first day class was, I think, the only time I actually went to 10 o'clock. Not even the time that I didn't realize we were starting class, I think last year. So I didn't show up until I was, here in shorts. I got a phone call from the department chair, and she's like, or his admin, and she's like, so are you teaching class tonight? And I'm like, well, not tonight, I'm teaching class next week. And she's like, well, we have class tonight. So I came over here. That class didn't even go till 10 o'clock. It started like an hour later. Anyway, general questions about the class before we do a quick recap?
Yes, is Rob speaking tonight?
Rob is not speaking tonight. Okay. Rob is in Barcelona. So,
well, that sucks.
That does suck. I went to, the Contender Bike Shop today and picked up some stuff for him for a very cool trip that I was going to go on. So it was good. I'll get even with him when he gets back. Other questions? Okay, your assignment that is listed, I'm sorry, this is Jonathan's piece that he added. The fund terms is not due next week. It's not due till the following week, right? So he wants to make sure that he's here to be able to walk through questions with you on that. Okay. And otherwise it would be due next week when he'd be teaching, right? So that's going to get pushed back home. Okay. Let's jump in and do a quick recap. What's the difference between an LP and a GP?
General partners have all the liabilities.
Okay. General partners have the liabilities. LP is limited in terms of liabilities, but also in terms of information that they have. Keep them less liable. The money comes from the LPs and goes into the GPs, firm and fund. Right? And the firms can have multiple funds, right, separated by years or different types of structures. This is pretty common. Jonathan will talk about the different waterfall structures as a recap next week. I know we did that 2 weeks ago. Who are the limited partners? Can somebody name a couple? Pension funds? Okay, that's the biggest one. Anything else?
Endowments.
Okay, endowments definitely on there.
Wealthy individuals.
Yeah. Okay, you can't have wealthy individuals. They have to be credited, which is kind of the same as
large estates.
Is that one the same? Wealthy individuals are large.
Accredited, you said, but it can't be a wealthy individual. He just has to be accredited, right?
Yeah. Yes.
Okay. One person.
And is it very hard to get accredited?
I think your current ruling is you have to have $1 million in assets other than your primary residence, or you have to make more than $250,000.
Is that the whole reason?
$200,000 a year as an individual, or $300,000 a year.
That's the whole reason that crowdsourcing came about, is so that people with less money could become involved in investing.
Crowdsourcing came as a side note, by the way, right? This is not anything that's going to be understand.
Right.
But crowdsourcing really came about because the cost to be able to get into these, startup businesses and entrepreneurs comes incredibly down, right? So people are starting businesses with thousands of dollars or tens of thousands of dollars instead of having to have hundreds of thousands and millions of dollars. So that combined with the fact that we're trying to have a broadening of the kind of the investor base for folks like that, is what created that. Now you're not talking about like Kickstarter, right?
Well, any kind of crowdsourcing, yeah. Kickstarter is the one where you can just throw dollars to something.
Yeah. So Kickstarter is a little bit different, right? Because with Kickstarter, you're not actually making an investment in the company. You're just making a pledge to buy a product that the company's selling. There are initiatives to actually let you, like Kickstarter, say, hey, I'm going to go online and I'm going to find a company to make an investment in because I'm not accredited. And then there are a handful of rules that will keep you outside of SEC regulation. That's not actually allowed yet. There are a lot of people working on it. It's supposed to be ready this year. I don't know if kind of the regulatory folks are going to make it.
That's part of the jobs bill, right?
that
Yeah,
kind of
it's part
stuff.
of the jobs bill, so it's supposed to get more money for the entrepreneurs, and it's supposed to allow everybody who's got retirement savings to diversify a portion of their retirement savings. But there's a chance for this to go really badly, right? Because you have all sorts of information as an institutional investor that you don't have as just a person who's picking a random company and giving them money, right? So the potential for fraud, I think Utah is like the per capita, penny stock fraud, winner of the country, right? There's more penny stock fraud here than anywhere else. There's going to be some problems with that.
There's a crowdfunding workshop on Wednesday put on by the Salt Lake City Entrepreneur Group, and Jason Best will be there.
So, which crowdfunding? Is this being like use Kickstarter or?
This is the equity crowdfunding.
Equity crowdfunding.
More related to that.
I may go actually. I haven't really been talking about it in a while.
Yeah, Jason Best will be there. He's been in Rob's class.
Yeah. That'd be
We're supposed to do
post an announcement where you are on the
all right.
on campus.
Yeah, I'll do that right now.
If I gave extra credit, I would give extra credit for that, but I don't do that. Just give me the
100,000 points.
100,000 non-counted common points instead of preferred
Fruit
points.
bucks.
All right, other folks here.
Trust.
Trust, right? So trust is likely down. So somebody threw out last time a sovereign wealth fund. And the sovereign wealth fund is really just a type of family office.
It's a what? A type of what?
A family office.
Family office.
Yeah, so the difference between a wealthy individual, or like a wealthy individual's family, and a family office is a little bit gray. But an individual, you're usually dealing with a person, and they're not they're not an investor. That's not what they do for a living, right? They made a bunch of money in real estate, and now they want to diversify their holdings. So you go talk to the person, and they're like, "So what does this memorandum state again? And remind me how the returns work, and when do you need my money, and that kind of stuff." Family office does that for a living, right? They've got a team of people, and sometimes these are just descendants. Like, so can anybody name like a Barron family from, like, not Barron, B-A-R.
Right.
Pardon?
Right. I know you didn't mean Barron
DuPont.
like they have nothing.
Yeah. Can anybody name like a Barron family from the United States history that would have a family office?
Like the Rockefellers?
Yeah,
or
the
something?
Rothschild.
Rockefellers have one.
Rothschilds.
Rothschilds.
DuPont. The
Yeah,
Mangums.
DuPont family probably has one.
Right.
Vanderbilt's have one, right?
Brent has his
So there
own.
are, actual wealthy individuals that lived in the past and they've died, and now those estates have family offices. Some of them are set up as endowments and trusts, but some of them are run by the family members. Frankly, those folks probably have a bunch of both.
What would be the difference between wealthy accredited individuals and angel investors?
Well, angel investors could be wealthy enough to be accredited and could make an investment in fund. But if you're an individual and you make an investment in a company, then you're an angel investor. If you're a wealthy individual and you make an investment in a fund, and the fund makes an investment in a company, then you're an LP. Does that make sense? This is the fund-company relationship. If you're an angel, you skip that whole process and put your money into the company.
Okay.
All right, we're missing one on this list.
Fund of funds.
Fund of funds. What's a fund of funds?
It's a fund that owns diversified fund of different.
That's another way.
Collection.
Yeah.
Funds.
So really, what a fund of funds does is it says, oh, we're going to take another set of LPs out here, and they're going to invest in fund of funds, and then the fund of funds is going to put money into this thing, and they take a little bit of a commission along the way, right? So this person puts a lot more money in, and this group takes out a little bit, and then that money gets passed along.
To that fund and many other funds, right?
Yeah, but they perform this diversification exercise, so if you've only got money to invest in one thing, you probably put your money in the fund funds and they split it up into a bunch of different stuff for the management account. So one goes down, you don't have to worry about it. So that's relevant because what do average returns look like in the venture capital world? Ballpark.
20? Oh,
They're usually less than 20%. I mean, it depends on what kind of time window, but assuming we're looking at the last 20 years or 30 years, they're probably in the teens, right? So we'll say 15%. Is that good? What are the returns for bonds? More or less than 15%.
less.
Okay. How about this? How about the stock market?
Less.
Less, right? So why don't people always put their money in these sort of mechanisms, even if it means they have to go through a fund plan?
Don't have enough money.
Yeah, it might be that you don't have enough money to get started in the first place. There are some things involved, but once you get to be big enough, you still don't put all your money into this bucket, right? Why don't you do that?
Risk.
It's risky, right? So for diversification purposes, you're usually trying to pick a bunch of different assets. Okay. So if these returns are 15% and you are an entrepreneur and you go to a venture capitalist and you say, oh my gosh, my business deal is the best deal ever. I can guarantee you 20% returns on your money. As a venture capitalist, what do you think?
Too good to be true. Walk
No
away.
way. He wants way more.
Sounds like Enron.
Well, believe it or not, 20% returns, not considered that high for a venture capitalist. Right? So a venture capitalist is going to take out a certain percentage of these returns on their way back towards the partners. Right? So 20% actually doesn't get it done. 20% is not enough for the GPs to manage it at 2% a year. Because at 20% and every year you take essentially 2% out, it's almost cumulative. So you can say like, well, that almost takes 20% out to start with. Then you end up with 0% over here for the LPs. Right? So that doesn't exactly work. Right? But if the average deals are 15% returns, these companies have to return something more than this. Like, what if the company said, hey, we're going to produce 40% returns? What do you think?
How?
Well, you better do your due diligence.
Yeah, and what do you think they're realistic? And they think, 40% is a reasonable, outlook for this kind of thing. Right? Does that work? Let me put a portfolio question in here for you together. If you take and put 20 companies together and they all say they're going to do 40%, and you're an early stage venture capitalist, can you take 20% off from your own fees and plan on getting 20% over here?
No way.
Why not?
Because probably half of them are going to fail.
Yeah, so that's the big reason why, right? So of these 20, you're going to have maybe 10 of these companies that fail, right? And then you're going to have maybe another 8 of these, call it 5 of these companies return 2 times their money to 3 times their money. And then you're going to get a couple of these companies that maybe they give you your money back. And what do we got here, 8? And then we've got 2 of these companies that actually give you some great returns, right? We would consider this 10 times return on your money a home run in the venture capital world. Right? This is actually, but a 10 times home run doesn't mean that these guys are always making 10 times their money. It seems really greedy on their part. If you're the entrepreneur and you're like, oh my gosh, how can you expect me to return 10 times the money that you've invested? Well, the reason is because, Mr. Entrepreneur, even though you think you're super successful might fail, odds are a bunch of people just like you in my portfolio are going to fail. So I have to have some returns here in order to make that work. But, they're not 100% returns or 1,000% returns on the business. They're just trying to work around the math to say, we need some of these companies to be a home run for us. And the number 10x is arbitrary. Right? The reason it's not 9x is, anybody want to guess?
Easier to do the math.
It's just easier to do the math with 10. And frankly, 10 looks bigger than 9. It looks more than 1 bigger than 9 because it's got an extra digit in it, right? Venture capitalists are relatively simple folks. So 10x looks way bigger than 9x, and it doesn't look that much smaller than 11x. So it's kind of the arbitrary points for home run. Okay.
So what you learn, make the
Um, that's it for recap. Let's introduce a new concept here. Let's talk about company valuation for a second. I'm including two formulas today. And we're going to do really basic math, but you're going to have to, on the exam, be able to apply it in story problems. So it's a little trickier than you're thinking. The first is pre-money valuation plus round size equals post-money valuation. Let's talk about valuation for a second. How do you determine what a company is worth?
Doesn't know the future cash flow.
We never do it that way. But that's what you learn in school, right?
Yep.
So this is Ken with his venture capital hat on, right? Ideally, what would you like to know about this business 5 or 10 years down the road?
Future earnings.
You'd like to know the future earnings, right? The cash flows that he was just talking about, right? How predictable are those earnings
Not
5 years earlier?
Incredibly unpredictable.
yeah.
Incredibly unpredictable, right? So that's why it's totally useless. But still, that's what you'd like to know more than anything else. You have a magic wand or crystal ball or something else to happen, you travel in the future, see how much money they're generating, and then travel back in time and make your investment decision. So all evaluations are an approximation of trying to interpret something around how the valuation works. Now, the reason you can't just say, well, we're going to take the present value of future expected cash flows is what?
You don't know.
You have no idea what those are.
Expected cash flows are.
Right, you don't know what they are, but you've got some guesses out there, right?
Yeah.
I think, like we mentioned, those are totally unpredictable guesses. So for example, suppose you said, I think, Mr. Entrepreneur, your business is worth $5 million based on your future projected cash flows at a discounted value. And the entrepreneur wanted $10 million valuation for their business. What would they do?
Increase the future earnings.
Yeah, they just double the predictions out there, and then they'd say, the next person they walk into, they'd say, well, if you do the future value of the projected cash flows, you'll see that clearly my business is worth $10 million. Right? So,
Can't you compare it to others in the industry and say that's an unreasonable assumption that they're making with those cash flows?
so we will do that, because that's a nice, simple trick that venture capitalists can understand. Right? So the second half, once we've done talking about valuations, we will talk about comparables. Right? And comparables are really just a venture capitalist way of trying to estimate for this future cash flow problem that we currently can solve. Right? And part of the problem with the future cash flows is, do the entrepreneurs know what these future cash flows are going to look like?
No.
They have a better idea than
Better idea than what?
better idea than someone that's not involved, that's not doing all the work, that's not pricing things out. They do some planning and some looking at how much will this cost and how much of a demographic grasp here compared to whatever competition I might have. So they have, a better idea than nothing. Right?
Yeah, they have a better idea than nothing, right? But do they have any biases?
Yeah. Yeah. Absolutely.
What are the nature of the entrepreneur's biases in this regard?
Specific industries and their own backgrounds.
Okay.
They're probably emotional to a certain degree about what they're into.
Yeah,
How
so
passionate into it.
interesting thing about these entrepreneurs is they're passionate and they have ego and they're driven and they're optimistic, right? And that combination of attributes means that they tend to overestimate what their revenues look like, right? And earnings are just revenues minus what?
Expenses.
Expenses, right? And so which way are they biased on the revenue side?
High.
High.
Yeah, so they're optimistic. So they're high. Estimates are high. And expenses?
Low.
Right, so their estimates are low on this. So then how about the earnings?
High.
Yeah,
Way
so
high.
way high, right? Almost unpredictable when you get these two weird biases that you go out 3 or 4 years, right? You just almost can't do it, right? And public companies are entirely driven by this. And so part of the nature of the reason this works from a comparative model is in the end, you might sell this private business that you have to a public company, and then you're going to live in their world on their public entity. Or eventually you're going to turn this business into something where it can get acquired in a mergers and acquisition transaction where somebody might, be relying on these types of protections. Those are probably the two most reasonable ways. Okay, so one way is to figure out what these numbers are going to look like is to actually use comparables. Who do you think has more control over the valuation? The entrepreneur or the investor?
Investor.
Does anybody want to make a case for the entrepreneur?
Well,
Yeah.
in a situation where a lot of people want in.
How about something like Facebook?
Yeah, like Facebook.
Yeah, like before they went public, right? But they had some private plans. Right? So what determines those dynamics?
That's a really unique case though, because they've been around for enough years and billions of people are using them. Like if you're talking about a regular entrepreneur that might need maybe a few stores or outreach within his own local area, I think the venture capital firm would have a lot more resources, experience, knowledge, probably of the market.
So what determines this price?
It's back and forth between the entrepreneur and the venture capitalist.
All right. So if the entrepreneur says my company's worth 10 million, and the venture capitalist says I think your company's only worth 5 million, how does it go back and forth?
Well, if you meet in the middle, great. If the venture capitalists don't do it, then they walk away and they go to another firm if they can find another firm. That's good knowledge to have, is if you know how many other firms are involved in evaluating them.
All right. So if there are other firms evaluating them, and they go to the second firm, and the second firm says 5 million, and the third firm says 5 million, even though the entrepreneur says, hey, this is totally unfair, my business, I don't understand why people can't see that my business is worth $10 million. What do you think?
Educate them on the market, help them understand what your thinking is as far as what the values of your product would be in the future, as far as the size of the market and the price you expect to achieve when you sell it.
Yeah.
But just the additional backup to help them catch the vision.
Sure, but suppose you do that and it still comes back 5 and 5 and 5.
Time to bite the bullet and say you're only worth 5 million.
Yeah. I mean, really what we're talking about here, and this is with my investor hat on, right? I've been an investor longer than I've been an entrepreneur, is these are determined by a market. And the market is, there's a certain number of investors, and they're out fighting amongst the other investors and trying to get their limited partners returns, right? Because it's not their money, right? It's your parents' pension fund money, amongst others. So you can go out as an entrepreneur and try and find other investors. Why, as an entrepreneur, does it feel like the investors have more control?
Well, when you're running a business, cash flow is king. I mean, if you need that money to expand or do anything, or you're getting to the end where you might run out of money, and you need some cash, and these guys are saying it's only worth this much, what do you want to do? Crash your business or take the deal?
Okay. Anything else?
Investors have a lot more choices as well. I mean, they're seeing potential businesses on a daily basis, whereas the entrepreneur, it's their one shot, it's their one product. They may try to go in at 10 million here, 3 million, 3 million, 3 million, and then they get someone that says 5, and they go, okay, that's our one shot to get even 5.
All right. So I think that's partially arguable because maybe say there's 600 venture capital firms. How many entrepreneurs are there at any given time that are trying to find financing?
Thousands.
6,000?
A lot more.
60,000?
Well, you're going
60 billion.
600,000 entrepreneurs?
Let's keep going.
That's an entrepreneur in all of us.
Yeah.
6 million entrepreneurs wanting financing. How many people are there in the United States?
300
billion.
300 million, so 600, so 6 million would be what percent?
2.5. No, I don't know.
More than that if you're talking worldwide.
Let's just stick to the United States for a minute, because I think there's about this many firms 6 million of
30, 300, 2%.
3%?
2.
2%. Okay. So if 2% of the United States is made up of entrepreneurs and all those entrepreneurs are looking for money, and there were 600 VC firms with 6 million investors, there were 6 million investment opportunities, what would the ratio be? I said I looked at 1,000 deals for every one we did. So what's that ratio? Yeah, that's 10,000. So that's why as an entrepreneur it feels like it's tough,
Yeah.
right? Because there are a lot more people that would like to get financing than there are firms, but the fact of the matter is, markets are relatively efficient, and they've driven this number down from 800 or 900 firms down to 600 firms. Because it's not a super efficient way to deploy money, right? I mean, there's just a lot of questions involved. There's a lot of transaction costs. There's a lot of information costs. You know, the liquidity of the asset is not that good. So it's not like the markets immediately reward and punish people for bad decisions. It takes a long time for those things to occur. Okay. But there is a market. Let's assume for a second that you come to this decision that your company's worth $5 million valuation. This is typically called a pre-money valuation. And in fact, in the venture world, we usually say pre plus round equals post. The way to shorten that. So if your company's worth $5 million, and you take $1 million of financing, what is your post-money valuation?
6.
$6 million. Right? Seems really simple. If somebody throws out post or pre, they're really talking about what's it worth before the investor money goes in and what's it worth after. This statement is true at the very moment that the investment happens. Once a week or a month or a year go by and some of this cash is spent, then the company's not really worth $6 million. This is a financing, like a snapshot of any given time. Right? So let's say in 2013, your business has a transaction that happens that's $6 million. As an investor, go ahead.
I was going to ask, I don't understand what round size is. I mean, I get the valuation, but where's the 1 million come from?
So if you're an
How much
investor,
it is.
right? So I'm making you guys be the investors
Okay, yeah,
for this purposes of this class. You give them $1 million. Right? What's their company worth? What's their company worth before you give them the money? It's worth 5.
Yeah.
What's it worth after you give them the money? Then it's worth 6.
Got it. Okay.
Technically, you can say, well, it's worth $5 million on the books, and then it's got $1 million in cash.
Got it. Okay.
But you know they're going to spend some of that cash in the following week. So really, what we're really pointing to a point in time and say our last financing, our firm was worth $6 million post and $5 million pre. Yeah.
What if that round of financing is put essentially into some type of hard asset? Is that, I mean, that's not really expenditure, it's capital, that's capitalizing.
No, as venture capitalists, we don't really understand accounting.
Okay.
So we don't really think about that kind of stuff. So literally, whether you spend on a hard asset or whether you, have some amount of debt financing that you do at the same time, right? We don't really think about those kinds of things. We really just think about what's the pre and what's the post. You spend it on stuff that's like some sort of fancy marketing program, right? Then what do you put that in, Goodwill or something else? Right? Literally, we just don't know. Right? In our world, this is really all I think about. And you'll see why in a minute, I think. We're trying to simplify doing math to figure out something particular. What do we know that's interesting from a venture capitalist standpoint about this point?
Just a question real quick. Do companies or can companies ever go with multiple VCs?
Yeah.
Okay, and so obviously whichever one's the first one, no other contracts after that can conflict with the first one, or?
We'll talk about the specific contracts after the midterm. Typically there's a no-shot clause. So if you have one investor and they say, I'm willing to make $1 million investment if the company's worth $5 million. I want 6 weeks, and you can't shop your business to anybody else. Right? So that's typically how that works. But it's not unusual for this $1 million to get split up. 2 guys put in $250,000. It's not so common with $1 million deal. $1 million is kind of small. And then you have a third guy who puts in So all
Is
total.
that no shop kind of what was going on with Dell just a little while ago?
No, Dell's a little bit different, right? Because they're a public company that they're taking
Trying
private.
to go back private.
And you've got a bunch of shareholders on the public side that are defaulting against Michael Dell taking the company and saying, hey, it's worth more than it is in the public markets. All right.
I was just gonna ask if you'd run on with that. So what are you hoping to accomplish in the 6 weeks of the no shop? What would be best case scenario?
So the reason there's any time period at all is you're just doing due diligence on the company. You're saying, I think your company's worth $5 million, and I'm willing to make an offer on it, and I need some period to evaluate it during which nobody else can make an offer on it and essentially buy the investment.
Okay.
But I need to check a bunch of stuff out in the meantime, and it's going to take me however many weeks to do that. That's the nature of that time period. All right. Anything interesting about this formula as an investor? If you can tell, especially the math. What percentage of that company do you own?
1/6.
Your own six?
Well, unless your 1 million states that you own it. I mean, what if you put in a million, but you get like half of the shares?
No, never works out.
They never do that?
It never happens. I mean, there's a couple tricks on this that we'll learn after the midterm, but at a really high level, you own 1/6 of this business. And what's 1/6?
20%? No.
16%?
16, yeah, about 16.
16.6%.
Is it 16?
About that. No, 16 or 17.
Say again?
16.66.
Is it 16.6%?
Yeah.
Okay. So you know what percentage of this business you own. Why do you care about that as an investor?
Voting rights in the future, control the company.
Yeah, there's all sorts of rights that are associated with the ownership percentage. Anything else?
How much money you're gonna take away if they're sold, or how much the earnings are, what percent of the pie you get?
Let's make this really simple. What if you sell this business for $100 million?
You get 16.6 million.
Then you get $16.6 million.
Don't you get your million back too, or not?
So we won't talk about that till after the midterm, but frequently you do. But for now, we'll just say, without any, especially if you don't have any preferred terms, right? You would own, and you're an angel investor, specifically, you own exactly 16.6%, you'd get $16.6 million. You can take some fees out of this for selling the company. But whatever the amount is, net of fees, you're going to get 16.6%. That's the biggest reason you care. So in all the negotiations for all the different things that go into the term sheet, the thing you care most about is what percentage of the business you're going to own. Right? And how much it costs you to be able to get that percentage of the business. This is one of two things that entrepreneurs and investors fight about more than anything else. Right? Is this number right here. What's my company worth? Suppose, for example, you had a company that somebody said was worth $5 million, and another investor came along and said, hey, I think your company's worth $6 million. Which of those do you take? They're not good. What does it depend on?
How much they're investing?
It can't depend on how much they're investing, right? What if they're investing $1 million and that gives you a $7 million budget?
Right, then they have 1/7 of it.
Yeah.
Yeah.
Depends on the terms too. They
Yeah.
may say you're a higher valuation, but they want more for the
Yeah.
dollar.
Yeah, so there could be a bunch of other variables involved, or it could be as simple as saying, you know what, we don't like this company, or they don't have the same amount of value add, or we can't stand to deal with them on the boards, or they're not going to help us sell the company. So there's some kind of soft issues, but the real hard issue is, most of the valuation, from an entrepreneur's perspective as to who to take, comes down to what percentage of the company does the entrepreneur get to retain? In this case, what percentage does the entrepreneur get to retain?
16.5.
So this is the investor. And this is the entrepreneur. But in this case, everybody can do the math? 1/7
It's 14.29%.
So that would be 85,
14 and a quarter.
So you might say, hey, look, I'd rather have an extra 1% of this. Because if you sell this business for $100 million, what does that mean in real dollars for the entrepreneur?
A lot.
It's $1 million, right? Or almost $1.5 million, right? So you may say, like, well, $1.5 million. I mean, You're talking about $100 million, who really cares? Well, when it comes down to actually splitting up the $100 million, a lot of people will care where that extra million and a half goes. So that makes a difference. But certainly when you do something like this, 10 million, that'll make a big difference. Make a difference in investor returns as well. Or something like this is also true. What if this person says, well, I think your company's worth $6 million, but we're a really big firm, and we get spread too thin if we only make $1 million investments. So we need to put $3 million worth. In fact, in this case, let's make the math easier. Let's say it's $4 million.
Stay on 40%.
So the post money is 10 million. So now, how much does the entrepreneur get?
3/5.
60%.
60%.
And the investor's going to get 2/5 or 40%. So which one is better?
Depends if you need cash or if you need
Exactly.
if you need
Yeah.
cash right now or what you need.
Yeah, cash or ownership.
If you can make the business worth 200 million, 300 million, or 4 million now, then it just depends on what you can do with that cash. If you can't put the cash to work to make it so that you get more coming out of it, it's not worth it.
So this is really the trick, right? Because you're trying to figure out, as an entrepreneur and as an investor too, frankly, how big a company can they get to? What do we think this company is really going to be worth? And what are the odds of that actually happening? Right? And if they don't have a plan if they have a good plan for putting $1 million to work and a terrible plan for putting $4 million, then frankly, this is going to be a better model for everybody. Even though there's some investors that will push for this just because they have extra capital to play. They'll actually mess up companies this way. It also means if you take the entrepreneur's perspective, it's nice to have a couple different plans, right? Hey, if we had $1 million, we would do X. If we had $2 million, we would do X and Y. But if we had $5 million, we would do A, B, and C and not do X and Y at all, right? And we think that is so much better than the other two. Yeah.
Would you be laying out those options to a single venture capital firm that has valued you and been willing to put money on the table, or is that something you're shopping around to different VCs?
Well, I think you're shopping to different VCs and you're doing diligence beforehand and say, what's the average size investment of these venture capitalists, right?
Okay.
If this is a late stage person and they need to put $10 million to work, then your pitch is going to look really different compared to an early stage person who only wants to put $1 million in the business.
But certainly if you approach a single VC that you've built a good relationship with, you're confident in your business, and you say, hey, like you said, with this we'll do, with 1 million we'll do X, with 2 we'll do this, and you're saying, what can you give us 2? We can do better with this. I mean, you present multiple options to someone that you want to work with.
Yeah, you can. I mean, usually they're looking for the investor to say, I want X.
Okay.
Here's what I want.
Okay.
And then sometimes the investors come back and say, what if you have a little more, what if you have a little less?
Got it.
And that's a good thing to be able to answer. But usually the entrepreneur has to make that offer. Yeah.
But you're saying most VCs, regardless of what the structure is, the bottom line is they're hoping that they're at least going to get 40% return.
So these aren't returns, right? This is an ownership percentage.
Right. But what I'm saying is then you then take what a return is based on the probability of what the ownership or what the buyout's going to be at a certain percentage and make all those numbers work together, right?
Yeah, and we're going to do that today. It's a little more complicated than you described it in the basic sense. I'm going to make you do some extra math. And part of the reason you have to do the extra math is this is an investment that was made in 2013. What has to be true in order for you to still own $16.6 million of this investment and have not invested any more capital in 2020?
You have to have non-dilutable shares.
No, non-dilutable shares don't really exist.
Wait, can't you, isn't that a contract specification?
You could put it in the contract, but the only time I've ever seen that done, that finished off the company. Because they needed extra money. And this is my friend Zach. And it turns out he, surprisingly enough, underestimated his revenues and overestimated his expenses, which meant that he needed extra cash. And when he went to go raise cash, the first thing people would find in due diligence is, wait a minute, your cap table has people with unbelievable shares. So as a new investor, you're just like, absolutely not.
So if you can't have a fixed number of shares of the company, how do you maintain a percentage of, how could you maintain a percentage of the ownership?
I don't know, anybody got any ideas?
Okay.
Well, what might happen in the future where you still own 16.6 million and not invest any more money? Is there a possible way for that to happen?
Yeah, keep investing in the company.
So that's one option. What's the other option?
All future sales,
Sell.
shares are sold on the other sides of their perception of shares.
There's a way simpler answer to this.
Don't sell any more shares.
Yeah, don't sell any more shares, right? If you never raise any additional money, then you still own 16.6% at the end. That's one way that would happen. Right? So you don't actually know in 2013 what you're going to own this business when you sell it. Right? You might own 16.6%. You might own that exactly because they never raise any more money, although every entrepreneur will always say, like, at the end of their pitch, or at least in the old days this used to happen, and in conclusion, I can reach my target goals and I don't need to raise any more money. Right? But that was very rarely the case.
So, I was typing, was the comment, don't let them sell any more shares? How's that any different from non-dilutable, because you're making it so the company can't get more money if they can't sell more shares, right?
Well, non-dilutable means you can raise more money, but the earlier investors still keep their ownership percentage. But if you never raise any, if you don't need to raise any extra money, then it would still be the case.
Oh, the owner has, like, say he has 80%, he could sell another 20% or another, okay.
They can sell part of their own shares
Yeah.
without diluting the rest of the investors.
Okay.
That goes down really fast. The biggest reason that goes down really fast is, from the investor's perspective, what's the ideal ownership percentage they would own?
At least 51.
So it's not 100%. Why is it not 100%? We'll talk about 51 in a
Taking
minute.
all the risk.
You've got an entrepreneur that has nothing to work for.
Sorry, is it the entrepreneurs don't have anything to work for?
Yeah, the entrepreneur has nothing to work for.
Yeah. So at that point, the investor becomes the manager of the business, right? And everybody else is just employees. There's no alignment with the entrepreneur or any of the entrepreneur's team to actually do anything big. So whether it's a $10 million exit or a $100 million exit or a $1 billion exit, it doesn't make any difference to the employees. Right? And that's a bad motivation model. What do you think you get as a typical outcome between 10 and 100 and a billion if it doesn't matter to the management team? You get 10, right? Do the employees stay past 5 o'clock to like work on an important deal? No, right? Do they like cut out? Do they take a couple of client phone calls on their vacation? No, they don't do that either, right? They take really long lunches when they have to fly someplace. So they fly business class, or do they fly coach, or do they fly first class? They fly first class, right? I mean, so you're trying to create some alignment between them. It's not 100%, right? 50, why do you say 51%? What's the obvious reason for that?
If you're the entrepreneur, you want to have control of the company.
All right. Well, it turns out the way we're going to get into deal structures, you actually get a lot of control over the company well before you get to 51%. Right? And some things you might not get 51%, but depending on the investor mix, you might get 60 or 70%. But the concept is that, right?
Yeah.
At some point,
As long as you hold the majority share, but if you only say you have 40% and you have the rest of those split up between multiple companies, if you have some hostile takeover dude who buys all those up, and all of a sudden you're not the.
But it's not that simple because the classes of shares have a bunch of rights associated with them.
Yeah.
And because of that, you don't have to own 51% of the company in order to usually enforce a lot of things. Like, oh, you want to give yourself a raise? Like, no, I only own 10% of the company, but me and two other buddies that own 10%, we're basically saying you can't pay yourself a raise, or give yourself a bonus, or do a bunch of other things that we don't want, right? Including things like raise another round. But we'll talk about those rights in a bit. I mean, like, all right. So one of the ways you might not own the 16.6% in the end is you might have another financing right. That makes this math a little more complicated, right? So let's suppose in 2018, 5 years down the road, as an investor, you're going to plan on getting another financing rate. Okay? What do you think on the valuation of the company? Let's just stick with this. Stick with the second one because the math's easier. What do you think the company's worth in 2018?
That'd be
Well,
worth at least 10 million.
An Ego office space, like the Elk do, so there goes, 2 million.
Well, it better be worth at least 10 million. I mean, you have inflation, and then you hope they're just making enough money
Ken
to
was
break
saying
even.
from the day that you give them the 4 million, their valuation is gonna start going down because they're burning through cash.
No, but they also, they're going to be spending, at the end of this, when they need to raise more money, they will have spent most of this, if not all of this, right? It's better for the entrepreneur if they don't spend it all. Why is that?
Because if it crashes or burns, you want your money back. At least some of it.
Well, but that's for the investor, right? Why is it better for the entrepreneur if they don't spend every last dollar of it?
Well, because then they have some type of flexibility or something that comes up.
Yeah, and what do you mean by flexibility?
I mean, they don't have to go out and get more financing, they've got cash on them.
Exactly, right? Because how is this valuation determined?
It's the pre plus the round, so if they don't have to go get, so their pre would be higher, but they still got some cash, so.
It's true the pre would be higher if it had some cash, but it doesn't, I'm not really asking questions related to the formula. But you said all the things that would lead you to the right conclusion, right? So you're saying they should keep a little bit of cash on hand so that they've got time, so that this valuation could be higher. Why would that valuation be higher if they had time? What would they do with that time?
What would they do at the time that it would take them to go get more capital?
Yeah.
They would shop around for a new deal.
Exactly, right? We talk about the fact that these things are determined in the market. If you spend all your money and you only got a week to raise more money, how many companies can you close deals with in a week?
Not many.
Probably none. Probably, if any, only with the person that gave you the $4 million last time, right? And that puts them in a really great negotiating position, right? So it's a weird dynamic when you're sitting in board meetings and the investors are like, oh, you should go ahead and you should take this risk. It's totally fine with us, right? It's a little bit of a moral hazard, right? Because the advantage is for the investor, if the entrepreneur runs short of cash, that will hurt the valuation. Now, on the other hand, it's not necessarily worth having a year's sort of runway and spending an entire year, because at some point, as an entrepreneur, you really should be running a business and not out trying to find money to run the business, right? So you get diminishing returns after some number of investment meetings. At some point, you're like, all right, I should just take one of these. You got a comment?
I was gonna ask, so that 4 million that gets invested, is that sort of with a stipulation that they're looking at a certain, maybe is what we'll learn, but a certain term for that investment? Like this 4 million is for, a 5-year period, and after 5 years, we're gonna talk about a new deal. And the main question I'm trying to get to is, if that is the case, and there's a certain term, and they don't spend that 4 million, they only spend 3.25, doesn't that show they're running their business effectively and efficiently, and that they're using their money wisely? That's their a viable business. I mean, is that sort of on the soft side?
This is a complicated question because what you really want as an entrepreneur is these mystical future cash flows that you can't predict.
Yeah.
Right? What that really means is you're looking for growth in the business, right? Growth on the earnings side, or specifically growth on the revenue side if you can't clear the ability to earn those things. And so you're really trying to take a guess as to how fast you should spend this money to try and figure out a maximum growth rate. Then you have to calculate what happens if we run out of money early. So how much of a buffer do we need? But if you're doing it in stages, then you have to do this weird calculation of, all right, do I take 4 million here and a smaller amount later, or do I take a smaller amount here and a larger amount later? There's a general philosophy, this is my philosophy, incidentally, that what you really want to do, and this is not on an exam, what you really want to do is you want to take enough money to be able to get to a milestone, right? That sometimes these valuations up front have more to do with the stage the company's in than anything else. So, for example, if you have an idea, you don't get a lot of credit for having an idea, right? If you've built a prototype, you might get some credit for that. If your prototype turns out to be an actual product, somebody might give you credit for that, right? So you're getting more valuation, you're adding more dollars to this amount compared to this amount, right? You take your product and you sell it, like you have a pilot, you get some feedback on it, people are like, I hate this product, it's terrible. Or, yeah, I'd buy 100 of these, right? That makes a difference. It's even better if you get an actual customer. right? Somebody that's not part of the pilot, that you actually get one finished and you say, how much would you pay for this and how many would you like, and they actually give you a purchase order, right? In fact, this is actually generating revenues, so this is at some point generating profitability. So again, not on an exam, but an interesting thing to know that you frequently get credit for those things. And that might determine how much money you would take with it, right? So you'd say, look, I have this prototype, but I want to skip the building. I want to be able to build a product and do a pilot and actually get a customer. So I think I can do this for $1 million, and I think I can do this for $4 million. So how does that affect what I think the valuation of my business is going to look like in the future? So we already said that by the time you get to 2018, most of this $4 million is going to be gone. So what do you think? Does anybody want to pick a valuation for this business in 2018?
Depends on if they've done good or not.
Sure. But give us a number.
Okay, say they're worth 10 million now.
Okay, they're worth 10 million again. Okay, this is an interesting case. They were worth 10 million in 2013, and then they're worth $10 million in 2018. Right? So the valuation of their company totally flat over the 5-year period. Right? Makes the math easy for you guys, because how much of this business do you own in 2018 from a percentage standpoint as an investor?
Same percentage.
Same percentage, 40%. And how much was your investment worth in 2013? In dollars, nominal dollars? $4 million. And what's it worth in 2018? $4 million, right? So that makes the math look easy. But from an investor standpoint, the valuation on this is not very much, right? Take a guess as to how much money they would raise. You would want to pick a number?
5.
Okay, $5 million. So post money?
15.
50. All right, so what does the investor own now? And what does the entrepreneur own?
33 and 66%.
So here's the way you have to split this up.
915 still.
Okay, okay.
The investor owns of this 10 million,
Oh, yeah, 920.
4 million, and the entrepreneur owns 6. Plus 5 million, where does the 5 million come from? This all comes from the investor, right? So of the 15, let's just say it's the same investor for a moment. If it's the same investor, what percentage does the investor own of the 15 million?
60%.
Yeah. So 9/15 equals 60% investor, and 6/15 equals 40% entrepreneur. You notice that the entrepreneur's numbers just go down. Right? Over time, the entrepreneur will never own a greater percentage of the business that they did after the very first round. Why is that?
Every investment after that dilutes their ownership.
Yeah, it's all dilutive, and they're not putting any more cash in, so their ownership percentage is just getting smaller. Now, the dollar amount of their investment, what their investment's worth, what their company's worth, can continue to go up, right? So ideally, they're taking in money, and they're going to sell it for $100 million, so their $6 million turns into, ideally $60 million. They never take any money, and you sell it for $100. But their ownership percentage after every round is going to go down a little bit more and a little bit more. Now, how about the investor's ownership percentage? Do they go down or do they go up? It went up, right? Is it always going to go up?
If the company is only valued at what it was the last time you did your rounds, is the beginning valuation, then yes, and your company's the only one investing in it, then you're going to continue to get more ownership.
And there's one more variable, though, that has to be true.
Nobody else is that.
And there's
Right.
nobody else coming in, right? So if there's only one investor, and then your ownership percentage is always going to be going up. There's some weird dynamics when you've got new investors coming in, and you don't invest. What happens to your ownership percentage?
Goes down.
Then it just goes down, right? What if you get to invest a little bit?
Well, it depends. That's
Yeah.
percentages at that point.
It depends, right? And there's a certain amount that would be exactly the same, right? And we'll talk about that when we get into preferred terms. Typically, there's a clause that says an investor, like I own 40%, I've got this right to be able to always maintain my 40% ownership. Even if somebody else is putting new money in, and I would be getting diluted, I get to put some money in as well so that I can maintain my 40%. Okay, but this is a really simple case. This is called a flat round. Flat round is a round that has a post-money valuation from the previous round equal to the pre-money valuation of the next round. Okay? Although the math is easy for you guys, it's not a great investment outcome for the investor. Okay? So let's redo this. How about something better in the flat round in 2018? Somebody want to pick a new?
15.
Okay, 15. And a new round size?
Let's just do 5 this time.
Okay, that also makes math easy.
Yep.
We have a nice round post-money valuation. Okay, so the value of the company has gone up 50% from 2013 to 2018. And on an annualized basis, that's not super good, but you know, it's better than, it's certainly way better than flat. So you go from 10 million to 15 million. What happens to the investor's ownership at 15 million in terms of percentages? Exactly the same, right? Nothing else has happened between this 10 and this 15 to change their ownership percentage. So what percent do they own of the $15 million? Does the investor own?
4 divided by 20.
So they own 40% of 15 million, which is $6 million. So in dollar terms, right? Here it's really easy. What does the investor own? Well, the investor owns 4 million. How about a 15 million pre-money valuation? Well, the investor owns 6 million. Okay, so what does the entrepreneur own? They own 15 minus 6, right? $9 million for the entrepreneur. All right, plus 5 million. That all comes from the investor. So how do you do the math on this? What's the numerator and denominator?
11, 20.
So the investor ends up with 11 million out of 20 million, or is that what it is?
Yeah, has to be.
Okay. So the investor owns 55%, and the entrepreneur owns 9 out of 20, which is 45%. Incidentally, how do you figure out what the entrepreneur owns here if you already know the investor owns 55%?
Whatever's left over.
Pardon?
Whatever's left over. If
So
nobody else invests.
one way to do it is to say 1 minus 55% is 45%. Would anybody else do it a different way?
You can just divide the number, like 9 million divided by 20 million, or 11 million divided by 20 million.
Right, so you would just say, well, 9/20 equals 45%. Okay? On an exam, I would do both. It's a nice, easy way to check your work. Okay? And typically, and the way the problems work, we don't give partial credit for these. Like, if you make a mistake in the steps of trying to figure out some of the things that I'm asking you, then you mess up the rest of the future parts of the problems. I think you do a bunch of different problems, so one problem's not going to destroy your grade, but I would check your math. I would do it both ways. Okay. So at the end of this, you own as an investor 55%, and you sell this business for $100 million. So instead of
Wait, you own 45%, right? You put in 9 million, 9 over 20, that's 45%.
No, the investor
No,
owns
that's what
55%.
the entrepreneur owns 45%, as an investor, you own 55%.
Didn't you put in 4 originally and 5 this time?
Yep.
Yep.
So that's 9 million, right?
That's true.
9 million out of the 20 million?
But you get some of the increase in valuation.
Oh, okay.
You get,
Some of you will make this
40%
mistake
of the
if you don't do the
Got
percentage
it.
process.
Got it.
Right? Okay. Let's do this. So let's say I have a $100 million sale.
Yeah.
You're going to get 55% is how much?
55.
$55 million. Right? What's that on an annualized percentage basis? What's your IRR on this investment? Is that an easy thing to figure out? Anybody do it in their head or on a calculator? You do it on a spreadsheet. Okay? So that is not a simple thing to calculate. It'd be worth doing. I'll ask you to do it for your valuation analysis that you do after the midterm. But it's way too complicated for venture capitalists. You can't do it in your head. What's another way to put a numerical valuation as to how good a return is?
Do that
Take
X
your 9
thing.
million you put in cash and divide that
Yeah.
by 55.
So we're going to take your 55 that you get back and we'll divide it by the 9 million in cash. What does that give you?
Gives us our
6X.
Is it 6?
I don't know.
6.11.
Okay, 6.1 x, right? We'll put x there as a number, right? So it's more common for the venture capitalist to say, I got 6 times my money back than it is to say, I generated this kind of percentage return.
Is it common for them to also say in period, in such and such period of time? No?
Because that would totally defeat the purpose of trying to simplify into one number a whole bunch of other variables that are moving around. Right? I'm not saying it's the best method. IRR is clearly a better metric for efficient use of capital, but this is what gets used in the industry more than anything else. And by the way, is this a home run? No, because it's not
10.
It's not 10x. Questions?
So they consider time value of money?
They don't, right? The multiple of return doesn't consider time value of money. The investment internal rate of return considers time value of money. But actually, just the multiple return does not. Okay. And I'll ask you to generate this number on the midterm. There's some sample problems that will generate this, but not this number. You'll have to do this number for the group sign. But you'll have to do this one only. All right. So interestingly, we had a round that went 10 million to 10 million, and that was called a flat round. What do you think the round that goes from 10 million to 15 million is called?
Growth round?
Yeah, something increasing.
Something like that.
A good round.
It's called a good round. It's called an up round, right? 10 million to 15 is an up round. Most rounds are up rounds, right? The nature of time that goes by means that most companies are increasing in revenue, right? But not necessarily all, right? So suppose in 2018, the company did not make efficient use of this $4 million in capital. What if they didn't even generate $4 million worth of value in the firm? What might you have for a valuation for this company?
A down round.
A down round. And what happens with the down round valuation? Pick a number for us that you could have that would be a down round.
9.
9, right? Anything less than 10 turns out to be a down round. All right, and you want to pick a round size?
2?
3.
I don't know.
Let's do 3.
Let's do 3 because the math's easier.
Yeah.
If you do 2, then you end up with 11 as a denominator. So this gives you 12 million. Okay. So pre-money, 9 million. 3 million round size, 12 million total. What does the investor own on a percentage basis?
8.44 million?
How do you do it?
About 58.
40% of the 9 million.
Okay, so this is how I would do it, right? 40% of 9 equals
4 nines is 44.4444.
44.4 million. Okay? So what does the entrepreneur own?
Is that 4 nines?
I'm not doing the math. I'm relying on somebody else to do the math. The big venture
My
capitalist.
bad.
3.6.
Yeah, sorry. 4 nines.
So I'm looking for a percentage.
And then 5.4 for the entrepreneur.
So what is 40% of 9 million? 3.6.
I did 4 nines, not 40%.
Well,
You're
okay, 3.6 million. All right. So what is the entrepreneur own? 5.4 million. And then the
6.6 million.
yeah, so 6.6 divided by
12. So you own 55%.
okay. This is the investment piece. Okay. You guys see how the math works? Conceptually, you could step through 4 or 10 or 100 different transactions. And you'd just be saying, okay, what does the investor own, what does the entrepreneur own of pre-money valuation? Add that to the round size, and then let's take the post-money valuation and we'll divide how much it is in millions divided by the post, and that's how we know what our ownership percentages are. This is a simplification that guys in the venture capital private equity world use all the time. If you're an accountant, you don't do it this way. Anybody want to take a guess as to how you do it as an accountant? Or attorney? So the way you do it as an accountant or an attorney is you build a capitalization table and you keep track of the actual numbers of shares and dollars per share of each of the pieces. It's a very big document, right? The numbers should end up the same, right? So your accountants and your attorneys, for those of you that work in the private equity space, will do that work for you. But if you want to do financial modeling, you'll probably do it this way, right? You'll use a simplification to try and figure out what's my ownership percentage. So venture capitalists, when they're talking to an entrepreneur at a party, can say, oh, interesting company you have. What was the pre-money valuation of your last business? Oh, how much money did you take? Okay. And how much did somebody sell for in your space? Okay. I can see approximately how I think this should work out for me as an investment, right? I'm interested or I'm not interested. They should make that decision. They can't go out and build a financial spreadsheet in the bathroom while nobody's looking and calculate all the shares and come back and say, like, I think that's totally exciting because then you aren't really going right. Okay. So, first formula for the day, pre plus round post. So I've got a couple options for you. We've got a mid-semester sample problem. I've got some more materials to teach. You could do this without the second half of the lecture. You guys want to take a break and do this now? You want to take a break and do comparables first and do the midterm sample at the end of class?
What's on the midterm sample in general? 5 problems. They have to do with valuation. They have to do with trying to figure out what your company that you invested in would be worth. Mostly it's in trying to determine how much money would you get if these different things happen along the way. Could you do the math and figure it out? That's what the sample problems are. They're story problems.
Yeah, I'm with you.
All right, you guys want to do sample problems first?
No.
No? How many people want to do sample problems first? How many people want to go on to the second half of the lecture?
I like Nick's idea.
I think sample problems are winning, but there's not a lot of people that voted. Let's try one more time. How many people want to do sample problems first?
All right, now I'm in.
Okay, now we have a majority, right? So we'll do sample
I didn't
problems first.
vote the first time.
Let's take a 5-minute break. Come up and grab one of these. They should be online, I think, if you're on campus.